when we invest, we have to show the founder, like capital is a commodity, right? Like I mentioned, like, hey, these founders have other options. We got to show like why we belong and why they picked, prove them correct that, hey, we were the right choice. So, and we believe, going back, you asked a question earlier, like, how do you find like all these companies? I said, hey, it's the founders. So the harder we work for these companies, the better the experience that they have. That means they're going to refer us more entrepreneurs to work with, more of their friends to work with. And then when they have a sale or an IPO, they want to work, rinse and repeat, and work with us all over again. So that's the formula.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Jason Caplain of Bull City Venture Partners, and Jason and I met at a conference not too long ago, and then he invited me to Raleigh to speak at his event called Founders First. And as we started talking more and more, I realized how much of an impact Jason and his firm make on founders and by funding them at earlier stages. And I also got to meet the community in Durham and Raleigh and all the different startups that he and his firm have been able to help. So I really wanted to have him on the podcast to talk about how they look at founders and at companies to invest in, what their approach is, and how they kind of vet deals or vet founders in particular and create the most value for their particular companies. So I hope you take a lot away from this episode, especially if you're a founder. You get to hear Jason's perspective on some of the critical things that they look for, especially within the founder themselves, more than the idea or the product or the company. So I thought that was probably the best takeaway from it. And there was a lot of great insights that Jason shared related to that topic and many other things as well. So with that said, I'll leave you to it. Enjoy the episode. All right, Jason, welcome to the show. How's it going?
Good. How are you?
Good. Excited to have you on. Obviously, we've been friends for quite some time. So why don't we start with giving a background about yourself, Bull City, and we'll go from there.
Yeah. So, thanks again for having me. Grew up in southeastern part of Massachusetts and worked for an investment banking firm out of school. Moved to North Carolina back in '98 for Red Hat and was 80th employee at Red Hat. We were doing about 11 million in revenue at the time, and joined in the finance group at Red Hat. How this whole thing started, our venture capital firm, is we took money from Greylock and Benchmark at Red Hat, two prominent firms, and we never really considered raising capital from regional investors. So, the thesis in starting this was, let's create a firm here in the region that the future Red Hats would take capital from. So left Red Hat in December 2000 and to launch the first fund.
Awesome. And in terms of Bull City, what are the types of companies that you're focused on and investing in?
Yeah, so I would say 90% of our companies look like this, where they're, call it seed and early stage. Usually they're software companies, and they're led by an experienced founder. That can take the form of a repeat successful founder or someone with just out of industry with deep domain expertise. But that's about 90% of the bucket. And we're kind of investing usually kind of up and down the East Coast. Every once in a while, you'll see us invest somewhere else, but most of the relationships are kind of close to home.
And on the seed stage side, so basically these companies are doing less than 5 million in most cases?
Yeah, absolutely. So we're kind of the it's not a hard and fast rule, but the companies I would say kind of in our general sweet spot are between 20 and 200K in MRR when we invest. Uh, Having said that, every once in a while you'll see us do something that might be doing a little bit, like we're digging in on a company right now that's doing much more than that. But we'll sometimes we'll invest in companies that are 5, 10, 15, $20 million in revenue when we invest. Usually they're very capital efficient. Maybe they got past us with an early round, and we're trying to make it right, and we don't want to miss. So we're trying to make sure we get a piece of it later. So good examples of that would be like companies like Wedding Wire or eTix, Double Positive. there's a pretty good list. I would say we kind of sprinkle in two to four of those per fund.
Got it. But then the rest are on the smaller end.
Yeah, the rest of those are the seed, seed, early stage, even pre-seed. We'll do some companies where it might be. We did one last year where it's two very successful founders, actually brothers, and one is in Nashville, Tennessee. The other one is in Vermont, and it was two guys and a PowerPoint presentation. So no code or anything, but just a really good idea. But this is the third company. So when we go really early like that, the pre-seed, it's usually someone we've known for a long time.
Right. And in those cases, like what is the founder profile you're looking for? You mentioned that. Like, is there certain characteristics beyond just being a repeat founder that has had some success that you're
Yeah,
looking for?
absolutely. I this may sound like a little silly, but it's finding the founder that you get the feeling you want to quit your job and go work there. So it's usually someone that's really good at recruiting. They have a good ability to sell the vision to customers, prospects, partners. They are good at capital raising. So they've got to have like that a visionary, be a good visionary, and also like a magnetic personality. And they're great at like surrounding themselves with other great people, right? So we always say like A people like hire A's, B's hire C's. So trying to find those people that have, especially in the case of the repeat successful founder, someone that has a really good ability to see around corners. They have been through lots of different economic cycles in the past. So that's probably a pretty good summary.
Right. What about when they're a little further along and like they're past this initial pre-seed stage and they have some traction? How are you evaluating companies then? Because they don't necessarily have product market fit and they also don't have enough data to kind of figure out how well things are working. So how are you vetting companies at that stage?
Yeah, it's still a lot on the team. David, my partner, likes to say we have this like 80% weighting on team. So, we're about to make a new investment, I think later this week or early next week. And, it's a very heavy weighting. We spend a lot of time and kind of over index there. And then it's like, do we believe that it's a big market? We'll validate that with our not only chatting with their customers, early on, but we kind of add our mix to it as well, and that kind of helps sell the Bull City story of like, hey, not only are these guys going to invest, but they've got this great network. They're already starting to help us out, and already starting to make introductions to valuable contacts out there. Helps us with diligence and helps them out at the same time, and so that we put a pretty big weighting too on like what's the feedback we're hearing from the market out there. It's not always accurate because sometimes people don't know what they want in the future, but we definitely use it as a gauge.
Are you more, and I've been to your Founders First event and met the types of companies that are there, and you've built quite a presence in the Raleigh Durham area with how many companies you know and how you've been able to serve that community. But when you look at these deals, is it more reactive in terms of the companies you're meeting, or are you going about saying we want to invest in this market now? Let's try to find the right company based on this thesis to kind of find somebody to back.
No, it's actually different. So I would flip it. We actually say this is the person we want to back. So this founder is on the sidelines. We want to back that founder. What can we find? What can we do with that founder next time around? So like, and we've done that on a repeat basis, not only with our founders. So like Scott Wingo, we backed twice, Troy McConnell twice, Robin Smith twice, but also like who else is out there that we have that feeling about the founder? Because I think it's like, I think if you go through it our way and you pick the founder, then they lock onto an idea that they really like, rather than finding an interesting idea and then forcing it on a founder. It's not really theirs, at that point, and they're kind of like more of a hired gun approach. So very very founder focused. Pick the great people. Again, we miss a lot because don't have perfect analysis around this, but try to pick a great founder, then lock on the idea, and that's what we roll with.
And is that in sourcing founders, and really that becomes a big part of what
It's
you need to
sourcing
do
founders.
then?
It's
Yeah,
sourcing
which is
founders.
where maybe other firms are maybe sourcing deals. In this case, you're sourcing founders, especially at the stage where you are. How do you go about that? How do you find these talented individuals?
I think it's like, the cool thing about our job, right, is every day is different and we're constantly having Zooms or, in person meetings. We travel probably more than a lot of other firms I know, to all the regions we care about, and in market there regularly to the point where we're part of their community. We get engaged. I was on the board of Venture Atlanta, I'm on the board of Mindshare in DC. So it's like getting involved in all these communities and, meet as many great founders as we possibly can do.
Right. And when you say you're in market, like how many of these events are you going to? Like you mentioned a couple there, like in Atlanta and some other folks, but just I'm trying to understand like what is the scale of this? Because finding a quality founder sometimes can look like finding a needle in a haystack, right? Or is it easier than that?
Yeah, look, I think we're less about. I think events are great, and I think events are good to like see and be seen, um, and raise the flag and let people know that we're around and accessible and all of that. At the same time, I think like our best deal flow comes from founders. So asking the other founders in market who they like, who they respect, um, is been like the recipe for us over the last 2 decades plus of operating.
Right. So just through referral and having the right relationships and good people know other good people.
Absolutely, yeah. Like our best referrals, we hear from the law firms, the accounting firms, and all the other service providers, and other VCs and angel funds, and go to all the events, and we're active on try to be active on LinkedIn and Twitter and all that stuff. Um, we post our email addresses on our website, but at the same time, we want to make sure we're activating all the entrepreneurs in the local market. And then we've got like our LPs out there, right? So our LPs are many of them are accomplished entrepreneurs, or they're executives at other tech companies. So they send deals our way, which is fantastic. And then we've got a very accomplished advisory board as well, and they're all active in sending us deal flow as well and helping us close, and work with some of these entrepreneurs.
Right. I think one of the interesting things about your approach is that when you look at ROI from deals that investors make, getting 2x return on your money over, or even 3x return is like a really good outcome when you're deploying capital, especially in later stage companies, because you kind of have to grow it. It's growing it from like, let's say 50 million to 100 million. It's not an easy task. And even if you do, like a lot of the value is kind of priced in. So finding that 2x, 3x return from what the investors that we work with, they find that to be quite a good return at the end of it all. But when you get in this early, do you find that because you're such a critical element of the value creation engine behind a company, that there is an outsized return that's available to you and your LPs because you're basically the first institutional capital, but almost like a quasi founder in some cases with these individuals?
Look, I know you said we're a critical piece. We look at ourselves as a small piece of the puzzle, you know, um, and a very minor piece. Like these founders have options; they don't have to work with us. Like I mentioned, they write their own checks. They usually come with a network. They've worked with other venture funds in the past. In some cases, we're having to displace those other funds, or work with them. Fit into their deal. Um, but they come with options. They certainly don't have to choose Bull City. Um, the So yeah, I mean, I just think that we're like a smaller piece, and then from a return standpoint, absolutely. Like we think about it this way, like when we invest in a company seed and early stage, we're shooting for like that 10x plus return that everyone talks about, and that's our hope and dream. When we're investing in a company that's later stage, it's maybe doing 5, 10, 15, 20 million in revenue. We're usually underwriting that to like a 3x return, but the strong belief that if all the stars align, it can produce an early stage like return, taking growth equity risk. And so that's how we think about that, and that formula has worked out really really well for us.
Understood. Yeah, that makes a lot of sense. And then in driving that value inside these companies, like once you invest, are you actively involved with the founders to actually kind of help them figure out critical items like product market fit or their go to market or their product roadmap, or are you more just hands off and letting the founders run with the business?
Yeah, look, we're so our belief is like when we invest, we have to show the founder like capital's a commodity, right? Like I mentioned, like, hey, these founders have other options. We got to show like why we belong and why they picked, prove them correct that hey, we were the right choice. So, and we believe going back, you asked a question earlier, like how do you find like all these companies? I said, hey, it's the founders. So the harder we work for these companies, the better the experience that they have. That means they're going to refer us more entrepreneurs to work with, more of their friends to work with, and then when they have a sale or an IPO, they want to work, rinse and repeat, and work with us all over again. So that's the formula. So yes, we will help out with recruiting. That's really really big. We'll help with fundraising. Um, we're working on a deal locally, a seed deal, and they David, my partner, has like they want to raise like 1.25 million, and again, we could probably write a smaller check. So he's having to help them fill out the round and make all those introductions. So capital raising, recruiting, we're big. I mentioned earlier, big on the customer side. So we want to be part of the sales pipeline. Um, and we're not set. I wouldn't say we're like selling, but we are making those introductions. So, we're doing that. We're already starting. I have a call later today with a company we didn't even invest in yet, but going through that process and helping go through our network and how we can like help accelerate their revenue.
What do you find as on the recruiting side? What do you find is one of the biggest areas where these businesses at the earlier stages need help with?
Um, Sales, marketing, also like usually some kind of finance resource. Usually that's a part-time resource initially, fractional resource. But we have two companies right now that are both local to North Carolina. One's hiring head of FP&A, another one's hiring the VP of finance. So usually those roles come up a bunch. Yeah, that's probably it. It's cooled down a little bit, by the way. I mean, it's definitely it's you go rewind like 2 years ago, it was just absolutely insane. So it's definitely hiring stuff like cooled down across the board.
I guess earlier today, and I'm thinking even as to how I founded this business in the early days. I was the CEO, I was the marketing person, I was the salesperson, and I was the services and product person as well, right? So it earlier stages companies, basically the founders have that challenge, and you're balancing cash flow versus growth and trying to think about how fast you can grow and serve the market. And at the same time, you want to stay like solvent and have the cash flow to continue operating the business, right? So how do you think about balancing those needs? And I'm assuming it differs on a company by company basis because software, as an example, is likely burning capital in those earlier stages as well. But curious kind of how you see that.
Um, yeah, I think you're absolutely accurate. I mean, um, one of our companies just is going with even though they're at scale, they're given how challenging it is right now to raise capital, they're going without a head of HR right now, and they promoted two people from within, two more junior people. So I think everyone is being like super cautious and trying to lengthen out. They've got a certain amount of capital and realize how hard it is and don't want to be out there fundraising this year. So they're trying to lengthen those dollars out as long as they possibly can to create as much runway as possible. But I think that makes sense. But yeah, we're seeing like I would say a couple of years ago less caution, and now it's very very tight.
Yeah, what advice would you give to founders that are listening where like they're when they think about their businesses and where the opportunities are or how much capital to potentially raise, like what avenues should they consider and how do they figure out what's the best avenue for them?
To raise money.
Yeah, to raise money because obviously there's a with you guys there's a specific path that they take, right? But there's options like bootstrapping and maybe waiting things out and seeing if you want to raise more capital later on, or if at all. So, just curious, like how should founders look at these types of investment avenues for themselves and try to figure out if it is the right avenue?
Yeah, no, great question. Look, I think it takes more names. So raising capital is a total sales process, right? Just like selling to customers, it's selling to VCs. Um, so, but we actually kind of flip it and say we're also selling to the entrepreneurs. But the I would say I'm seeing some like companies like create a hit list of VCs that are 100, 200 names long, and so it's I think gone are the days you can run a quick process, and I'm talking about this at the earlier stages, okay? That where gone are the days you can build a list of like 10 names and go tackle it and you get like two term sheets. That's not happening. So I would say that we had one company that went built out a list of like 150 names, and we helped them tackle some of that to go out and raise capital. But it's kind of doing whatever it takes. Also, I think it's like not just thinking about VCs. Like I think like everyone's like you go to TechCrunch, right? And it's like not making fun of those guys or anything, but like it highlights all the companies that raise venture. But I think there's other sources. It's going to family offices and individuals, and I think it's like getting creative about who else is a market that can write checks, and also entrepreneurs need to connect with entrepreneurs for referrals. That doesn't happen often enough. So getting those introductions from your fellow entrepreneurs, like, okay, this company just raised $10 million locally. Chatting with them about how they did that is, I think, would be really helpful too. And that doesn't happen enough, surprisingly.
Totally agree. What do you think about debt and leveraging debt as a potential capital vehicle, especially in the earlier days?
I'm very the bankers are going to hate me with this. And there goes all deal flow from my friends that are bankers. But I'm very like anti debt early on. So I believe like there's a time and place for debt, and it looks cheap, right? So the interest rate's low. You get a little warrants. They've got a great network. I'm talking about venture, traditional venture debt guys. What happens is like eventually it has to be paid back, and who's going to pay it back? It's like the existing investors. So I just mentioned earlier how tight it is to raise capital. Well, at some point that's going to come up, and you raised $1 to $3, $4 million of debt. That's going to be paid back. You're going to raise more money. I just talked about how hard it is to raise capital, so that like puts the company, in my opinion, in a really tight spot. Having said that, we believe like in the magic box. So like if a dollar goes in on the sales and marketing side, and you get like $3 out. So if you follow all of your advice, right, that you give companies, they probably get like $4 out rather than three. So when that comes out, once you have that magic box discovered, I think their debt makes a lot of sense. So when you get more of a predictable revenue stream coming in, and you understand there's less risk in the business, I think it's a great time to raise some debt. But early on, hey, because you can't raise equity, you start loading up the company with debt. If I look at the last like 2 decades of 23 years of doing this, our worst companies have loaded up with debt because they couldn't raise equity, and so they raise money in debt. And I think that's an unfortunate spot to be in.
Do you think it was a better idea 2 3 years ago when interest rates were much lower versus
Same,
now? And
same. I think it's like
interesting.
you gotta be like totally convinced you can pay it back. Like, how do you pay it back? Because you get to pay it back, you have to raise more money. Because what happens is at the earliest stages, when you start spending the bank's money, like all right, so let's say you raise like $3 million, and then you raise another million and a half in debt. When you get down to the bank's money and you start using their money, that's like a huge like no. So you've raised the money, you got a little bit, you think you got a little bit of padding, but then the bank wants to know, hey, when are you going to raise the next round of capital, so that you're not using going into their proceeds. So given how hard it is to raise right now, I think that's it can put the company in a really bad spot.
Yeah, and it puts the founders under a ton of pressure where like you're servicing the debt and then you don't have enough sales coming in and you kind of get on this treadmill, you can't get off of it in some ways. So
Again,
um,
I think also venture capital is expensive too. By the way, um, but my opinion is like, again, there's a time and place for debt. I just think, hey, when you have a more predictable revenue stream coming in, I think that's a great spot to take it.
right, right. Yeah. What about things like convertible notes or using safes to fund companies? Because
Mhm.
that's kind of quasi equity in a lot of cases, no?
Yeah, yeah. Um, Look, we've done all of them. We've done safes, we've done convertible notes, we've done everything. Price rounds. I think my only concern is like sometimes we're seeing founders like stack some of these safes, so they'll raise like a safe, this month here, and then they'll raise another safe like next month and the month after, or maybe even spread out 6 months apart. So all of a sudden we see a company and it's got like four, different times they've raised a safe, and it's like they've got now like $10 million that needs to convert into an A round. So that becomes a little more tricky to run. Um, we've also seen a company recently where they had closed on some safes the same month, but at different caps. So I think it's like keep it really well organized, maybe do it once, and then raise a price round if you can. But I think if a lot of founders have this tendency, like, to kick the can down the road. And again, I think there's a time and a place for that as well. But I think it's use it once and then try to go to the price round if you're able to.
Your point about debt definitely resonates with me in that even just from a personal finance level, right? You don't want to load up on debt unnecessarily. Like if there are assets behind it, then it makes more sense than just taking on empty debt, right? I think it's similar with companies, but when we think about companies, people almost start behaving differently and taking on obligations that maybe the vehicle that they're in may not be capable of handling. And then the second thing I wanted to just touch on is what you said is sometimes venture capital is more expensive than debt or just some of the most expensive type of fundraising. Can you expand on that a little bit more?
Yeah, I mean, like, uh, my point there is just like, hey, you, it's not for everybody. You pick a valuation and it gobbles up a chunk of equity there. Not all not all investors are equal, right? So I think it's understanding what the value add and what you're going to get out of that. Is it just like a passive check, or are they going to grab a bunch of equity? But uh, what did Amazon sell early on? I think he said like he raised money at a $4 million valuation initially, and raised $1 million. So he gave away 20%.
Mm-hmm.
At Jeff sold 20% of the business. So yeah, that's just my point. Is it can be very expensive.
And what about just this idea that founders kind of have to, they're playing multiple roles, but there's two pivotal roles that from a cash perspective are super important. One is obviously fundraising, and you need to raise money to keep the lights on and fund the operations, and the other is actually driving sales and revenue. And from in my experience, and I would love to hear what you think about this, I found that founders or CEOs sometimes lean too much one way or the other, and it's often to their detriment. And I'm wondering if you've experienced that as well.
Yeah, I think at the end of the day, the best companies are good at both, right? Like they attract capital. Like I have this thing where I kind of say that there's like A quality companies and then there's everybody else. Like the A quality companies have that all down, right? They have the sales and marketing engine going. They're maybe at the early stages, they're growing 3x year over year. They've got great unit economics. And those companies, it's hyper competitive right now to get into those companies. We looked at a company down in Atlanta. It just got 6 term sheets. And then there's the B quality company where maybe they
Wow.
don't have the sales and marketing engine down. Maybe they're growing 2x or a little bit under 2x, or there's something else. Maybe unit economics is a little bit off, and they're not able to raise. They don't have access to capital as well.
And do you find that in terms of backing up a jockey or an investment, like even those B level investments, like it's almost like, hey, if we help them figure this out, they're actually an A investment. So you're kind of underwriting that into the deal, or is it better to compete for those A level deals, even though there's way more competitors out there and it's like dry powder fighting each other for a higher valuation?
Yeah, yeah. I mean, I think I think it's okay to do B quality deals. I think there is. I think the A quality stuff for the most part is like way overpriced. Um, and maybe you go for the A minus or the B plus. But usually, usually chasing the market where everybody else is going, all the other investors are going, is usually the wrong place. If you look at the again look at the data for, that of companies we've invested in, our most successful exits, the ones that have generated 10x plus for our LPs, are ones that no one else liked, for a very very long time, and so including some of our IPOs. It was markets that no one else really thought were really interesting. Some people might laugh when we made the investment. That's the place that generated the outsized returns. So the deals that we went after that everyone else was interested in, those are actually haven't done as well.
Yeah, it's kind of like the value's already priced into those investments, and like they kind of say with real estate, you make your money when you buy the asset versus when you sell it. It's kind of like that, right? Where you actually want undervalued assets more than perfectly priced assets that, or maybe overpriced assets, right? And then you can generate a much higher return.
It could be a flawed area of venture, like you get a big partnership, 20 people sitting around the table making decisions. New partner shows up. They don't want to bring in a B quality deal. They want to show that they have access to the highest quality and don't want to take the risk of the B quality stuff. So I think that's kind of like feeding this as well.
Right, right. Yeah, I think it's nobody wants to like get a base hit. Everybody wants to hit a home run, but there's only so many home runs out there, right? So,
Yeah.
and in a kind of reverse logic ways, like if you buy an undervalued asset, your return on that, generating a 2x, 3x, 5x, or 10x return is easier than if you've overpaid for an asset, because now you're kind of like chasing the valuation that you paid for it, right?
Yeah. I think it's hard to, I depends on who you talk to. Some investors have a different view, but I think our view is like try to pay fair, reasonable market valuation for companies. We've stretched for sure ourselves over the years and learned to do that. But I think we try to stay in line the best we can.
Yeah, I think it's a balance, right? It's like I think it's Warren Buffett who said like it's better to buy an excellent company at a fair price than a fair company at an excellent price.
Yeah,
So
we agree.
I think that's the flip side of it, where
Yeah,
right you want to find great companies as well.
great entrepreneurs.
Yeah, and great entrepreneurs. Exactly.
Yeah.
I think that's great, Jason. I think let's end the episode on that note. But before we do, what's the best way if founders are listening and they want to get in touch and learn more about what you guys do? What's the best way for them to reach you?
Well, since Joanna started it with giving her email address, I will do the same because she did that with your podcast that I watched,
Yeah,
and
absolutely.
she gave out her email address, which I was shocked by that she did. Just picking on her. But my email address is jason@bcvp.com.
Awesome. We'll be sure to include that in the show notes, and I'm sure you'll get pinged by a bunch of founders as well. So, with that said, appreciate you coming on the episode and sharing your wisdom, Jason.
Yeah, I enjoyed it. Good seeing you.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you enjoyed today's content and want more of it, please subscribe to the podcast on your favorite podcatcher. Number two, if you are in the market for marketing strategy consulting services, due diligence services, or fractional CMO services, please visit our website at www.howtosas.com and schedule a consult today. And number three, if you haven't already, grab a copy of my book, Post-Acquisition Marketing. It's available on Apple Books, on Amazon, and any bookstore that you can find online. Get a copy because it walks through the framework that we take all of our clients through, and it'll definitely add value to your business. And that's it for today. We'll see you guys next time.